Hey everyone. Today I'm going to explain one of the most fundamental and widely used methods of business financing, debt financing. We'll explore what it is, the different types available, its advantages and disadvantages, and how it compares to other financing options. Let's begin. Debt financing is when a business borrows money from external sources with the agreement to repay the principal amount plus interest over a predetermined period. Unlike equity financing, where you give up ownership, debt financing allows you to retain full control of your business while accessing the capital you need. The borrowed funds must be repaid according to agreed terms, regardless of business performance. Key characteristics include fixed repayment obligations, interest payments, no dilution of ownership, and tax deductible interest in most cases. Think of it as renting money. You pay for the privilege of using it, but you don't give away any part of your business. Debt financing comes in several forms to suit different business needs. Short term debt includes working capital loans, trade credit, and lines of credit typically repaid within 1 year. These are perfect for operational needs and cash flow management. Long term debt encompasses term loans, equipment financing, and commercial mortgages, usually extending beyond 1 year. These support major investments and expansion projects. Specialized options include invoice financing, asset based lending, and government backed loans. Each type serves specific purposes and industries, offering flexibility in how businesses access capital. Debt financing offers compelling advantages. Ownership retention means you keep full control of your business decisions and future profits. Tax benefits include interest payments being tax deductible, reducing your overall cost of capital. Predictable costs with fixed repayment schedules make budgeting easier. Credit building through consistent repayments improves your business credit score for future financing. Lower cost of capital compared to equity financing in many cases, and no requirement to share profits with investors. It's straightforward: borrow, use the funds, repay with interest. However, debt financing has important considerations. Repayment obligation exists regardless of business performance. You must pay even during difficult periods. Cash flow impact from regular payments can strain operations if not properly managed. Collateral requirements may put business or personal assets at risk. Qualification criteria, including credit scores, financial history, and business performance, can limit access. Interest rate risk, particularly with variable rates, and potential covenant restrictions that limit business flexibility. The key is ensuring you can service the debt comfortably under various business scenarios. Understanding the difference is crucial for making informed decisions. With debt financing, you retain ownership, have tax deductible interest, face repayment obligations, and keep all profits. It's suitable for businesses with steady cash flow and established operations. Equity financing involves giving up ownership stakes, sharing profits with investors, no repayment obligations, and potential loss of control. It's ideal for high growth startups or businesses needing substantial capital without immediate repayment pressure. The choice depends on your growth stage, cash flow predictability, risk tolerance, and long term vision for your business. Debt financing works best in specific situations. Established businesses with predictable cash flows can handle regular payments. Asset purchases like equipment, vehicles, or property, where the asset itself secures the loan. Working capital needs, inventory purchases, and short term operational requirements. Expansion projects where the return on investment exceeds the cost of debt. When you want to maintain full ownership and control, or when you have good credit and can secure favorable terms. Tax considerations also play a role. The interest deductibility can significantly reduce the effective cost of borrowing. Debt financing is ideal for businesses with predictable cash flows, those wanting to retain ownership, companies with good credit profiles, and businesses making asset purchases or funding expansion. Your next steps: assess your cash flow capacity, compare different debt types and lenders, check your credit worthiness, and consider the timing of your financing needs. Remember, debt financing is a powerful tool when used appropriately. The key is matching the right type of debt to your specific business needs and ensuring you can comfortably service the debt. If you are ready to explore debt financing options for your business, visit us at www.fundingagent.co.uk. Cheers, everyone.